Is the QQQ a falling knife here in July of 2022? I was reading this article, which is a good article, and we're going to go through it, and they give some rationale supporting the point that the QQQ may indeed be a falling knife right now. This article here on SeekingAlpha came out on July 10th, so it's very recent. And this is an opinion piece from an author here on SeekingAlpha, Man Yin Tu. Hopefully I pronounced that correctly. And if we just go down and check his profile real quick, before joining SeekingAlpha, I was a trader at a proprietary trading firm in Hong Kong. I graduated from University of Sydney with accounting and finance. If you like my articles, please consider subscribing and becoming a Patreon. So I just want to give the author credit because they are the ones that put this together. If you like to read stuff like this, like me, my affiliate link for SeekingAlpha is in the description. Get you a free trial and 50% off your first year. But now let's get back to the point of QQQ as a falling knife. So they do a quick summary up here, but I'm going to go through it in more detail so that we can fully understand what this person's hypothesis is. And he kicks off the article with some, basics, brief history of the Qs. Here you also see the annual returns, including when it launched back in 2000. Tough start to launch in the .com era, obviously had a lot of losses there. Then you fast forward to 2008 and the housing crisis and all that was involved with that, and you had another bad year. But the last, call it 12-ish years off the top of my head, from 2009 to 2021, are mostly positive. And down here, he has the monthly close for the Qs across, basically decades. Is what it comes down to. And you can see how that's illustrated. This is, of course, the share price, peaked at 100 or so in 2000, 2008. I don't know what this number is, but it had to be in the, I'm guessing, $25, $30 mark. And then obviously you had a huge upswing, and now we're seeing stuff melt down. And with this recent meltdown here, the author compares it to some investing study done by Dr. Jean-Paul Rodriguez. And it is an interesting comparison because even if you just look at this chart, you can see, some of the potential similarities. But bottom line here, you've got evaluation and you have time, and they break stuff into different phases. So stealth phase, awareness phase, mania, and then blow-off phase. And dotted within here is some other events that they discuss: media attention, enthusiasm, greed, fear, capitulation, then a return to the mean, which is represented by this dotted line. So if we just eyeball that and kind of burn it into our memory, and we look up here, you see that potentially, if you're just going off comparing graphs, you might very well have a situation where this falling knife is going to fall much farther down, perhaps to the $100 level. We'll dig into that in a minute. But this is the summary that the author put together. Now, his chart here starts with the blow-off phase that would have been back in 2000, okay? But since that was a long time ago, let's pick it up a little bit in the stealth phase, which interestingly enough does include 2008. But he's calling that the stealth phase, then the awareness phase, and finally the mania phase. And I think most of us would agree, that the mania, if you will, of the stock market certainly started to unwind here at the end of 2021. Now, if we can all agree that the mania phase is indeed ending, if not already over, I would say the mania phase is definitely ending at the bare minimum. Then we go down here and look at the work of Rodriguez. The mania phase puts you right about here, and this is titled New Paradigm, okay? Then you have a drop of denial. Then you have some return to normal. Then you get into fear, capitulation, all the way down to despair. So I think the important thing here is understanding, are we in despair mode? That's an opinion. That's an opinion word, and some people have different definitions. But if it does hit despair, then you're going to start seeing an upswing to return to the mean. Now, does that mean, in this graph, does it have to fall this far to get to despair? It certainly appears to be the way that Jean-Paul Rodrigue would put it, because he created this graph, and it needs to come down below the mean to hit despair. So we are definitely not close to the mean with QQQ here yet. Here we have a quote from Rodrigue's work. Business cycles are a well understood concept, commonly linked with technological innovations, which often trigger a phase of investment and new opportunities in terms of market employment. The outcome is economic expansion, and as the technology matures and markets become saturated, expansion slows down. Now, this is a very important sentence, right? Because it identifies the change that would go from here down to here. And the change is after economic expansion and as technology matures and markets become saturated, expansion slows down. A phase of recession is then likely a possibility as a correction is required to clear the excess investment or capacity that irremediably occurs in the later stages of an economic cycle. All right, so let's stop there for a second and let's look at our monthly close. And the question really becomes, if we go back to that quote, what is the mean? How much do we have to contract to get back to what the mean is in the time period that's available, right? So if you go back to 2012 and you just pictured, a mean line here, it's going to come across, roughly in this neighborhood, and that would be how far you have to drop to get into despair mode. Now, if you go to, call it 2019, and you did the same line, we're obviously much closer. And if you got to, let's just say 2010, as I stated earlier, you have much farther to go, potentially down to the 100 or 150 mark for QQQ. So again, in a lot of ways, it just depends on how far out you want to measure. But let's see how the author describes it. QQQ probably has a 22-year cycle. So in this case, on the chart below, they're looking back to 1991 or so. Today, few people would deny it has entered blow-off phase. I tend to agree with that as well. Without the Fed's intervention, NASDAQ would have collapsed in March 2020, and if history were to repeat itself, it would have to undergo a deflation like that of the dot-com bubble in 2000. Based on market fractal evolution, a possible projection of QQQ after the blow-up would look like this. The author then goes on to provide this chart, which his trend line is the dots in red, obviously starting back from 1999. We talked about this a little bit ago. And just eyeballing this, it looks like the trend line into March of 2023 would be somewhere in the neighborhood of 210, call it 225, just for argument's sake. So with that in mind, in order to get to despair level, the Qs have to drop even farther. And in this author's opinion, that drop is somewhere in the $100 mark. Today, the QQQ trades about $280. So that would be more than a 50% collapse from today's price. And then finally, according to the author's simulation, QQQ can reach the floor somewhere around 105 by June of 2023. The market may then slip into another stealth phase for some years until investors' interests come back. All right, so what's my personal take on this article? Number one, I enjoyed reading it. And I think the author did a great job of providing graphs and data points to support their hypothesis. Now, the one thing that is different about this particular opinion compared to how I look at things is it's really based more or less on a momentum factor. There's not a lot of fundamental discussion in here. You're looking at price, you're looking at movements through phases, and there's a lot of opinion/emotions. And emotions, of course, are difficult to project because they're a function of human irrationality. Now, that being said, there is definitely some similarity here. And you could argue that Rodriguez's chart, maybe we're in the fear. I don't know that we've had this bump, this bull trap bump up to return to normal. I don't really see it. I mean, maybe it's this one here on the Qs. But if I had to guess, eyeballing the monthly close chart with Rodriguez's chart, I would say we're probably more likely in this fear level. But even at the fear level, you're still talking about the potential for a huge drop here. Now, where my brain goes is back towards fundamentals, and that's what we talk about a lot on this channel. And the QQQ doesn't have a ton of history in terms of earnings per share and in terms of like a PE ratio, but the NASDAQ as a whole does. Now, the QQQ is the top 100 stocks of the NASDAQ, so there's certainly some similarities in here, but there's also a ton of small tech companies, startup companies within the NASDAQ that would affect some of these calculations. So, take that for what it's worth. But if we look at this chart, which gives us, this is macro trends, by the way, and I believe this information is free because I'm not logged in. So here on macro trends, they do a nice job of stacking up stock price, trailing 12 months net EPS and PE ratio for us to look at. And we know which way the stock price is going. We've already seen that. And this, by the way, is not the Qs, right? This is the total NASDAQ index price, which is right around 156. And just to clarify, this article specifically is talking about the QQQ, not the NASDAQ as a whole. So there is some discrepancy here, and I just want to keep calling that out. But if we look at trailing 12 months EPS across the NASDAQ, it's pretty obvious that the EPS has grown most years except for 2016, okay, and 2017. I'm not sure what happened in these quarters. I don't know if there was a stock split or something. I don't want to comment too much because I don't know for sure. But if you were to follow this trend line, right, if we were to make a trend line of EPS, you started at $1.25 in 2009. Today you're in the $7 range. Obviously this trend line is going to be heading up probably somewhere in this kind of trajectory. Let's just call it 546 or 478, something like that. So this is good, in my opinion, because the EPS, a foundational element to fundamental value, is going up, and you need the EPS to go up to really hold the weight of the stock, right? Because this is a core metric that is easy to measure and is not necessarily an opinion, right? Now, the valuation, aka PE ratio, that goes through spikes and mania bubbles, and we certainly saw that here. I don't think you could argue that the NASDAQ PE ratio as a whole is cheaper today than it was back in 12/31. It was riding through these years in 2010, 2011. You were below 10, certainly at the 10 line. And then these past few quarters, you're at 22, 25, 29, 25. The question, of course, is what is the most reasonable valuation multiple? If you're going to say that it's 10, well, then we would take the P ratio, or the multiple would be 10. You would multiply that by the EPS. Let's just call it 7 to make it easy. 10 times 7 is a price of $70 for the NASDAQ composite. Today, the composite's at 156, and that assumes that earnings stay in this level. So if earnings drop, let's say down to 559, and you multiply that by 10, you have a price of 55, and that's something that you haven't seen since roughly 12/31/2015. So if we do return to these type of multiples, then I would say yes, this NASDAQ composite is in trouble. But as a counter argument, let's say that these earnings stay flat or potentially even go up from here, right? Then you have the fundamentals working in your favor, but you still have to worry about the valuation. So if we go pre-COVID though, I'm just going to say, 3/31/2019, P ratio was actually higher. And that was before we had all these COVID problems. But that's a small stretch of time. This is a longer period of time, but then you have to start thinking about interest rates, unemployment, health of the economy, etc. Right now, all we see on the news is bad news, right? But what happens if that mood changes? Would you stay at 22 for the valuation multiple? Would it go up to, here's a 30 back in September of 2019? Or does the mood sour and get to this 10 spot here? Now, flipping over to this QQQ holdings tracker that I created, it's got the biggest names in the QQQ, which is, that's a top weighted ETF. So the larger the market cap, the larger the share of that individual company occupies in the Qs. And if we just eyeball revenue, I've done this several times on this channel. If we just eyeball revenue year over year in revenue forward, you can see some slippage. Here's Google. They were plus 37% last year, and projection is plus 23% this year. So there's definitely slippage, and I would say that goes along almost every single stock in here. The important thing to keep in mind, though, is this is still growth, right? This is not backwards. This is still going forward, just not at the same pace. Now, we talked about that EPS on the macro trends page, and we have EPS year over year, percentage growth, EPS forward. These are all projections, just like that article was a projection, right? Same thing as revenue. We'll do some eyeball. You got EPS year over year, EPS going forward, and they even have a 3-year EPS. I would argue, that's very hard to project, but it is what it is. So as far as these two columns go, let's look for companies whose EPS is expected to contract. So for this table, it will be represented with a negative number. And we go on EPS forward, and you get down, here's a single digit growth, Cisco, so that could go either way. And then you have Intel coming down potentially 13% on their EPS line. Keep scrolling down here, and that is about it. You have some single digits, PayPal, Pepsi, Meta, as far as EPS forward. But again, these are all positive. So we had a total of one company that's projected to have a regression in their earnings. It doesn't mean that more companies won't, eventually land negative, but the fundamental of this chart, EPS, in my opinion, as far as projections go, looks like it has a solid chance to continue to grow on the QQQ level. And then from there, you're down to what multiple people will pay. Okay, so through all those numbers, what's the bottom line opinion, at least my opinion? My take is, of course, it could go down from here, right? I don't think that's a super surprising take here at 280 or whatever the number is. But does it go down to 100? Does it crash completely? That I don't see. And when I think about that study that Roderick did that was quoted in the article, there's a lot of talk about an innovation cycle ending. There is still a lot of digital transformation ahead of us, whether it's in cloud computing, AI, electric vehicles, heck, even video games and consumer electronics. I anticipate all of those categories to continue to push the boundaries. And for that reason, I see a lot of future in the QQQ, and while it may dip perhaps even more, we're not even through the summer yet, we've got an earnings season coming up, but I will continue to add to my position. All right, guys, let me know what you think of the QQQ. Is it a falling knife or not? How do you see the innovation cycle and the investor sentiment cycle? Before you go, don't forget to check out that special offer for Seeking Alpha down in the description. Hope everybody's having a great day. We'll see you on the next video.